Are U.S. consumers still strong? And does that mean everything's okay? Stock markets are up. That seems to be good news. Seem to like that release. So is everything okay then? Well, let's have a look and see. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is take a look at the retail sales report that came out today and get a sense of whether the markets should have liked it, and more importantly, why. Because they certainly appear to have thought it's pretty good. But let's consider why they might have thought that, because this actually matters. And from there, see how the story might continue to build when we get consumer confidence numbers tomorrow that give us a little bit more of a lens into this very critical piece, not only of the U.S. puzzle, economically, stocks-wise, currency-wise, yields-wise, but certainly globally as well. So we'll start with essentially where retail sales landed. And we can see here, at least at the headline, no question, a better number than anticipated. So we have here a 0.6% gain. The expectation was a 0.1% gain from economists. So needless to say, this is a positive thing. Now, in fairness, this is an important caveat. These are nominal numbers. So they do not take into account the impact of inflation. Now, if we were to remember that, of course, we just got some CPI data earlier this week, we take a look at the month-on-month increase there as being 0.6%, well, then when you subtract inflation from retail sales, you end up with zero, a flat result. But it's important to consider that, of course, we are not here just tossing around economic numbers, we're trading. So when you consider that, in fact, real spending was flat on the month, the important thing to remember is that the markets know that this is a nominal series. They're already discounting that inflation is running where it's running, and they are going to react within the context of the numbers as they present themselves in relative terms. So a 0.6% increase that is flat in real terms is better than a 0.1% nominal increase that is a decline of 0.5% in real terms. So in that sense, seemingly a better number. However, when we look at the internals here, the picture starts to darken quickly. Because what we see here is of the 0.6% increase in retail sales, 0.56 to be precise, it's rounded to 0.6, 0.39 or 0.4 if you want to round it off of the 0.6 is gasoline sales. So overwhelmingly, even in nominal terms, before we think about inflation, in nominal terms, 70% of the increase in retail sales was gasoline. There are middling increases elsewhere, but what's really interesting to look at is the collection of items in the negative side of things. So when we look down at what actually saw receipts decline, it was furniture, electronics, and appliances, which of course are sensitive to Fed rate hikes. These are things that are often financed. Sporting goods, hobby, and music, which obviously lean strongly in a discretionary spending kind of category. And so when belts are tightened, there's a good chance that this is where the squeeze is going to come before it comes, for example, for food stores or clothing. And so you have seemingly this sense in these data that spending, absent gasoline, was actually quite anemic. When you add everything up together, you end up with about a 0.1, 0.2% increase in spending, ex gasoline. And when it comes to the buying of gasoline, it's not necessarily demand that is reflected here. It's price. So if we look at what's been going on with U.S. crude oil and gasoline prices, they were in remission since about the middle of last year. And of course, most recently, we've seen them rise. Now, I will hold back my well-worn skepticism of OPEC's ability to actually deliver on threats of output cuts that move the price. We've talked about this at length on Macro Money before. To quickly summarize, Saudi Arabia said it was going to cap output by 1 trillion or 1 million barrels a day. So hold back 1 million barrels per day through December. OPEC as a group tends to outproduce its own quota by about 3 million barrels per day on average this year. It's outproduced it by 2.5 million on average since they started having active management to this quota back in 2014 or so. And they are vastly underperforming relative to capacity because they are, of course, trying to hold some things back. They're trying to cut output. So there's spare capacity that's there. In the past, the experience has been, at least in the past 5-6 years or so, that OPEC is responsive to prices in a reactive direction, meaning when prices go down, output is cut. When prices go up, it's quickly rebuilt because people want to be selling expensive oil when prices are up because that makes more money. So that Saudi is able to do this obviously depends on whether other producers step in and dilute their impact, and history would suggest they will. So that aside, the durability of this rise in crude and gasoline prices aside, they have been rising. And so this appears to be mostly a price effect rather than anything else, which leaves us with an interesting conclusion. If spending is anemic and the sectors most hampered, again, excluding gasoline, are those that seem to most suffer from higher interest rates and seem to speak to a consumer that's more defensive, opting not to go for big ticket items like furniture, electronics, and appliances, opting to forego discretionary things. If this is what the trend is looking like, and this is 1 month's data, so let's not over extrapolate too far. But if this is what continues to come out of these numbers and the trends on display here build over time, well, then what we're looking at is a situation where it seems like the U.S. consumer is finally starting to feel the pain that the Fed has been looking to apply. And we are reminded here, of course, that the Fed is actively trying to cool the labor market because this is the lingering pocket of inflation it feels it has actual agency to drive. So if we looked at the latest numbers from CPI earlier in the week, we of course see that core services, or services excluding food and energy, continue to be the overwhelming driver of inflation. The big components here have been housing services, which is essentially the owner equivalent rent component. So for owner occupiers, the rent that they would need to be paying to live in a comparable house to what they own. So, in other words, giving a sense of housing costs. And in the most recent report, very tellingly, auto insurance costs. Both of those seem to be primarily a function of higher Fed rates impacting liquidity in those respective markets. We spoke just earlier in the week about how the average interest rate on outstanding mortgage debt is 3.6%. The average mortgage rate that one could go get in the market now is 4% higher at about 7.6%. So people are discouraged from moving because they're discouraged from selling their homes, because if they've locked in a mortgage at 3.5%, why in the world would they want to go out and get another one at 7.5%? They're going to try to do everything they can to avoid that. And so inventory of homes has collapsed. Home values, because there are no sales, are being held up. Not so much because of rabid demand, more so because of illiquidity. Something very similar is occurring, in particular in used cars, but in autos. If you have this very expensive funding structure to borrow for a car loan, number one, you're going to try to buy a used car. Number two, if you have a used car, you're going to try not to get a new one. You're going to try to upkeep as much as you can. That means more repairs, but it also means higher insurance claims. Hence the jump in insurance costs. Now, both of these things don't really have any room for the Fed to have agency. One might ask, well, they could just cut rates and unlock these markets. That may be, but of course, that would encourage inflation to become more entrenched elsewhere. And with the labor market still as tight as it is, there's no telling that consumers wouldn't just run inflation right back up in that instance. And what the Fed is trying to do is contain it. And so this is where the proverbial rubber meets the road. The Fed is looking at this and saying, well, we have still a meaningful supply-demand imbalance in the labor market that is keeping the labor market very tight and that is keeping costs from falling. We can see that CPI has come down from over 9% to just under 4%. The core component here, excluding food and energy, has come down from just under 7 to just over 4. So there's been significant disinflation on both fronts. The Fed has had good success there. But the employment cost index is down less than 1% from 5.1 to 4.5 as of the second quarter. So what we're looking at here is a stickiness in labor cost, and that stickiness is coming because there is still this shortage of labor. And of course, prospective employers can only compete on price, i.e. wages. And that's the part that the Fed is looking to unstick, because here rate hikes can actually have a disinflationary impact. Clearly, they can't magically create more labor supply, but what they can do is hurt labor demand by slowing economic activity. Essentially, what the Fed seems to be after is a kind of round of wage agreement reset. So a lot of those higher wages that were locked in when these shortages were even more acute last year and perhaps the year or about 6 months before, let's say from about the middle of 2021 or so, as that has remained, and as that has slightly started to move, what the Fed would like to see is actual layoffs to reset and perhaps rehire those people at lower levels of wage elsewhere, which would then unlock a degree of this inflation. Now, we're probably going to have labor shortage continue here for longer term demographic factors. We, of course, were looking at a bit of a labor shortage already going into COVID to the tune of about 1.5 million around the start of the big retirement wave for the baby boomer generation coming out of the labor market. But nevertheless, here we are at about 3 million, almost double that. And so if we look at the situation now, there still seems to be, at least in the Fed's mind, room to squeeze. And this is why they keep saying that eventually these rate hikes are going to generate an increase in the unemployment rate, which has not been the case so far. Why not? Well, if we look at what the makeup is here of labor supply versus demand, the demand piece is the current number of employed in the U.S. added in the number of job openings. So the number of people in work and the number of people that companies want to be in work. And of course, labor supply is just the size of the labor force, the amount of people working and the amount of people looking for work or formerly unemployed. So, in looking at why the unemployment rate hasn't gone up yet in this environment, what we find is that much of the adjustment from 6 million to now about 3 million has come from a decline in job openings rather than outright layoffs. There of course, have been layoffs. Tech industry is front and center there. We've seen some layoffs in finance as well. But we've not seen the kind of mass layoffs to really bring up the unemployment rate and change the dynamic. But job openings have been slowly inching down, showing us that the labor market is, in fact, starting to lose an element of demand. If we look at non-farm payrolls numbers going all the way back essentially to the peak there, 904 in early 2022, we can see there's been a steady climb down, but still positive increases. The jobless rate has started to perk up a little, but it's still very, very low by historic standards, which of course is a problem for the Fed because that doesn't reset those wage agreements and therefore keeps labor costs sticky, which is what we're seeing here. CPI is coming down, but labor costs are only going down a fraction of what you're seeing elsewhere. This then suggests that when we're looking at the retail sales numbers as they present themselves this go round, and we get this level of defensiveness, that perhaps the squeeze has started to arise and labor markets, in particular consumers, are starting to feel the deceleration and are getting more defensive finally. To the extent that this then continues to feed a decline in spending, which is 70% of U.S. economic growth, it should begin to echo as layoffs because companies are going to respond. Less economic activity, less sales means lower earnings, means there's room to scale down. So, is this in fact what's going on? Well, we'll see. Because over the course of the next 24 hours, we're going to get a look at consumer sentiment. And the expectation is that we're going to get a second consecutive month of deterioration. If we get the sense that, in fact, consumers are becoming more defensive, that would suggest that, in fact, the pain that the Fed has been looking to achieve, and which it said would come with about a 12 to 18-month lag in sort of sum total after rate hikes started, that pain is now here, and that it will be with us in the coming months as more and more of it filters into the economy. Fed, of course, started the rate hike cycle in March of last year. So that would mean that right about August and September is where you should see the kind of big 75 basis point hikes that they did toward the middle of last year and a little bit after really start to bite in earnest, in full. Now, from the Fed's perspective, this probably means no more rate hikes, if in fact this is what's going on. And in fact, we can see the likelihood of one in September is now a meager 2.3%. There's still about a 33% chance that there is one in November. And if there isn't a hike at either of those meetings, then an 8.7% chance on top of that we might get one in December. Cumulatively, that's a 44% chance that we get a rate hike before the end of the year. Needless to say, that's less than even, and it's down a bit today in response to this retail sales data, it would seem. So when we look at that and we say, okay, well, surely from the market's perspective, this is good news. Well, indeed. We seem to have that response. Fed rate hike odds are down a bit today. Stocks are up. Bonds are down a bit. The only spot perhaps that's a little bit weird is the US dollar, which you might have expected to weaken, but because of a drop in the euro for European Central Bank related reasons, and you can see yesterday's episode of Macro Money for that, we laid the case for why that would happen in that show before the ECB actually did what they did, and the outcome was about as expected. So absent that, the markets are pretty happy with this because they are still seemingly focused on anything that keeps the Fed from pressing on with rate hikes is a good thing. And when we look at what happens subsequently, then we can see the market now thinks the cycle is done. Rates are not going to go up again, or are not likely to go up again. And we now are looking at about an 80% chance of a rate cut in June. That rate cut is fully baked in by July. A further cut is fully baked in by September of next year. And by December, we're looking at 3 cuts and a 36% chance for a fourth. So from the Fed's perspective, this is maybe a sign that what they're doing is working and they can back up, or at least cool their heels. From the market's perspective, this is good news because they've been laser focused on anything that the Fed can use as an excuse to pause being good, is good. What it isn't good for, though, is the global economy. And if we look at what's going on there, we can see there is potent deceleration of global growth underway at this point since May. And that's as the pop in the service sector has deflated. Much of that pop in the global service sector is probably the reopening in China. That has clearly been some kind of a positive lift when you take the world's largest population, at the national level out of lockdown and say, you can spend again. You can go to restaurants. You can take the transports. You can go and travel around the country, if not overseas. So there was clearly a pop in the service sector there, and China was probably aided there with some latent spending of leftover stimulus money and pandemic savings out of the U.S. and Europe, and some re-engagement with services that perhaps were still looked at with some suspicion before. And so you have this kind of lift in services, but now it seems to be coming undone. And the global economy is increasingly, as you can see by the composite index there, moving toward a neutral setting. 50 in the logic of PMIs is neither growth nor contraction. Under 50 is contraction, above 50 is growth, and movement up and down denotes speed. So the move from a higher value above 50 to a lower value above 50 denotes growth, but at a slowing rate. And as you get to 50, you arrive at standstill. If you were to get under 50, then movement further away from it, so deeper under 50, would denote speed of contraction. So a number that is closer to 50, but under it is contraction, and then a number that is lower and further away from 50 is faster contraction. So what we see here for the global economy is it is approaching idle. It is sort of drifting to a stop. Now, global growth fundamentally relies on three economies that are the overwhelming drivers of demand. The U.S. is the largest at about 24%. Then there's the Eurozone with about 15%, China with about a fifth, 18%. That's 57% of global GDP. It's actually more than that when you consider that 43% in the rest of the world depend on demand from the former three to a large extent. They're largely vendors, many of them. So, for example, think of Canada and the U.S., or Australia and China, or much of Central Europe and Western Europe. So it's actually more than 57%. The impact is actually greater. Well, the Eurozone is ostensibly, if not already in recession, then certainly very close to it. Here, the service sector is actually shrinking at this point, as is the economy now for 2 consecutive months. So you can see that composite line is under 50 and is getting deeper under 50. So not only has the Eurozone economy shrunk in the past 2 months, according to this, the pace has been accelerated. It's still positive growth in China, but just barely so because, of course, as we just talked about, that pop in the manufacturing, or the service sector side, rather, manufacturing has been anemic since early in the year, but the pop in manufacturing that crested earlier was then followed by the pop in services cresting in short order thereafter. So we got a bit of positive manufacturing growth. That's been back into contraction territory for a while, but now services has joined it and has pulled down overall growth to near standstill as well. So we're looking at a situation then where this success that the Fed is having threatens to essentially knock out the last leg that the global economy is standing on. Because if it's these three economies, and the U.S. is the last one to have any kind of meaningful resilience, and 70% of that is consumption, the signs that we're seeing from consumption that the markets are cheering as of today, anemic retail sales and maybe a decline of consumer confidence, confirming that consumers are defensive to to come with us tomorrow, maybe that's now bringing the threat of a global recession much closer to home. In fact, if we look at where the U.S. is on these comparable metrics, we are already near standstill on the composite reading here. So putting all this together might well be the kind of thing where we see numbers out of the University of Michigan on consumer confidence that belie a more defensive stance. And perhaps the markets reckon, well, it's not so much that this is good news because the Fed will stop. That much has been priced in. This is bad news for the reasons why the Fed will stop, because this bodes ill for earnings. That U.S. consumers, the last bastion of resilience for global growth, are starting to fold. And that the global recession that then follows will be bad for earnings and so bad for stocks, might encourage a flattening of the yield curve, expecting easing to firm up in the outlook looking out into next year, and reflecting some haven demand once again in the buying of bonds, especially at the long end of the curve. That might be supportive for the yen and gold, which tend to do better when the markets anticipate lower interest rates in the future. Might also be supportive for the U.S. dollar, which might continue to gain amid liquidation as the go-to cash of choice for that kind of thing. Now, will the markets decide all of this on the basis of just the consumer confidence report? Maybe not. But if the evidence begins to mount that this is what's occurring, well, then it seems like risk appetite sits atop a time bomb, which, with enough data showing the level of consternation accumulating over the coming months, might well go off. And that is Macro Money for today. This is the last show for the week. We will, as ever, be back next week, Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live, looking at what happens in markets after a given day on Wall Street and contextualizing it with what is happening around the world and what might be in the cards next. We're increasingly joined by the great Dylan Radigan, so definitely come and check out that show. We are back on with Chris tomorrow for Futures Power Hour, as we are every Friday. I am also on with Tom and Tony for First Call on Sunday evenings at the opening of Asia Pacific markets and futures markets here in the U.S. I am also writing for the News and Insights section of tastylive.com and opining on Twitter, yes, Twitter, at Ilya Spivak. Thanks very much for joining, everybody. Happy trading. We'll be back next week. Take care.